With the S&P 500 in breakout mode here at the end of January in front of some of the biggest and most influential stocks about to report earnings, we're going to focus exclusively on the index today. So let's start with the bullish patterns. And this chart is as of Monday's close on January 26th. And we know that through Tuesday, the S&P was getting closer and actually made a marginal new high. So really we care most about though is how far it can extend from this breakout area. So this is right around 68.80. As we can tell here, the S&P first eclipsed that after completing this bullish pattern on December 23rd. And then from that point, it's just been a back and forth track, right? Oscillating right around that zone. And so we decided to color code this area just to show where the risk is, right? Obviously into green and above it, we're in the clear, obviously bullish, and there's a better chance of the upside target getting acquired. Yellow, of course, it's caution because getting back down to the breakout zone and below it is bearish. And you dip below that, just a few days ago. And because of the reversal so strongly the next day, right, we had the 2.1% decline and then the first 1% gain in 37 trading days right after that. Because that was recovered so quickly, we've continued to keep this pattern on our pattern grid. And so far that has been the right decision because, again, we're still getting closer to or doing a better job of staying above that zone for now, right? This is always a moving target, and any, big miss from any of the biggest names could change things. But for now, we're giving the benefit of the doubt. It's a price action we care about most, not what's going on outside of that. And along the way, we've been tracking this version as well. I actually started talking about this upward sloping neckline when it was right here, right? It's first starting to attempt to break out in the middle of December. It didn't work out. That created another higher low potential, right? That also didn't work out. And now we're tracking it this way. And as this continues to go on, it's going to be more difficult for the S&P to actually, stay above an uptrending line because it's been trying to do so over the last few weeks. And eventually we may have to discard this version of the bullish pattern unless we see a really strong move to the upside and they continue to stay above it at this pace. Just moving sideways like this with an upward tilt isn't a negative, but we want to share the most pertinent patterns at all times. And so along the way, right, this has now created what could potentially be one of the biggest bullish breakouts if judged on a multi-week basis. Now, again, not very big compared to these other ones, but it's been about 3 months. Remember, the S&P topped here in late October. Now we're in late December. So 3 months, basically the end of last earnings season. Now we're into earnings season for the first quarter of 2026. And along the way here, right, a few months, obviously a little bit longer, less than a few months in the middle of 2024. And then in terms of time, not that long from March through June, July of last year. And so, just because we're knocking on the door of new highs doesn't mean that this attempt is going to fail, because each one of these we could have said the same thing about, right? And they continue to go higher. So again, we're respecting all patterns for as long as they remain viable. Now, so the question is, how did we get here? Well, the first thing was that, remember, this was that big gap lower, right, the day after MLK, where the S&P plummeted 2.1%, tariffs, concern over Greenland, so forth and so on. When that was reversed, it did so at a critical technical spot, right? Obviously, right near the lows from the end of the year, which lined up with the 38.2 retracement level of the rally from the mid-November low to the most recent high, later, just a few weeks ago. So key spot to hold, and that just created, a trampoline effect with the market ripping higher now, again, marginally making new highs here on Tuesday. And so what that did as a result, from a bearish pattern perspective, right, is to avoid these bearish potential breakdowns that we saw. For a long time, people were calling this a bearish rising wedge pattern, and we talked about it as well. Again, we don't like the label of this just because I don't consider anything bearish that has been rising consistently for a month. At some point, uptrend lines are going to be broken. That just means that the pace is changing. No matter how strong a market is, it just can't continue to go one way without any sort of pause. That pause came, and yes, we are below this line still, but the breakout area way above it. And we can tell that, getting back into this area, this is completely voided at this point, right? And so that came and went, got the downside break, lasted for a day, and up we went. Now, from a more classical pattern standpoint, anytime the market tops, we're going to show that there's a potential bearish pattern in play, which there was again. And every time that you have a big pullback, right, that is, has one or two big declines within it, is going to have a lot of negative headlines that seem worthwhile, again, to pay attention to. We can't ignore them, but the rhetoric always seems worse when it's happening in real time. So far, that hasn't happened. And so with the S&P again making a new high today, this bearish pattern potential has also been voided, which, as we know, has been the case every single time thus far, going back to May, right? Sometimes we saw the S&P go below a key support line, which it just did a few days ago. Happened again December, November, but prior to that, support held each and every time. So while the volatility has gotten a little more noticeable just in the back and forth movement ever since October, the one key trait that has continued is that bearish patterns have failed. And probably heard me talk about this many times, right? There's a number of traits that we track very closely at CappThesis to understand what type of trend we are in, or at least that we're not in, right? And one key is seeing bearish patterns fail. That usually tells us we're in an uptrend. At the very least, it tells us we're not in a downtrend, right? This is an important one to keep track of going forward. Let's take a look at the MACD next. But before I do so, if you're enjoying this type of content, I urge you again to check out our free Cap Notes newsletter on Substack, where we share a lot of premium content, including 3 key silver charts that you have not seen yet. If you haven't read this, check it out. Of course, a lot of other notes regarding sectors, groups, market cap, videos, so forth and so on. Again, it's capnotes.substack.com. Look forward to seeing you there. So another key gauge we've been talking about a lot is the MACD. Not because it's worked well, but because it has failed. And both of those results are extremely telling, right? This is nothing new. But you hear all the time how momentum slows. We just talked about it in terms of bearish patterns failing. When bearish patterns fail, that means momentum also fails to roll over. And so just because of the extreme movement, from the February high to the April low and back and forth, right, that created, one of the biggest discrepancies we've seen in the MACD in terms of low and high. So because of that, we've seen a lot of whipsaws here between the MACD showing sell signals all on the way. And so that has just really gave us an indication that this uptrend is not ending so far, right? The only time that did not play out, or the only time that we had a successful MACD sell signal since then was back in November, when the S&P was down 6%. Not a huge amount of downside follow through here, but enough to say that it was successful. And so from that point, there's been 3 others. And again, one of them happened right after that big 2.1% decline, which of course then gave way to another upswing. And so at some point, that's not going to work over and over again, but we track it every single time to see just how eager investors are to step in once more. And going even further back, right, to August 2024, how many times have we seen successful MACD sell signals? 3, right? So this just tells us what type of market we've been in from that point. Now, from a weekly perspective, maybe you don't hear about weekly MACD sell or buy signals that often, but we should pay attention to them. So we have both MACD buy and sell signals here. So the blue show the buy signals, red, of course, sell, with the dark blue showing successful buy signals, and the dark red successful sell signals, going all the way back to the COVID lows. So a few things here. Number one, there's been a lot more sell signals than buy signals, right? So before this, there were 9 total sell signals, 6 of them failed. Where of the 5 buy signals, 4 of them played out. Is that's because these can only happen, the buy signals, if the market has a distinct downturn, right? So that happened, needless to say, after COVID, right? As the 2022 bear market was ending, during or right after the pullback from that, August to October 2023, when the big rally happened, and again, a few months or a few weeks after this most recent April low, and off we went, right? Along the way, the only ones that played out from a sell signal, right? 2021, the beginning stages of that correction in August 2023, and then at the end of 2024, again, the S&P did make a marginal new high, as we know, a year ago before rolling over. And so most recently, we have another sell signal that just hit in the second week of November, just this last year. You remember, this was right in the middle of that 6% pullback. And it looked like, things are about to roll over. We had a bearish pattern in place. We had a daily MACD sell signal. We also had a weekly MACD sell signal. And what happened? Buyers came back in. So far, the S&P hasn't blasted through those levels yet, but has done a much better job of negating some of the momentum warnings from that point. And once more, most important thing, none of those digestive phases resolved to the downside. And this is one way to track that. So from a GoNoGo perspective, still remain in go mode. And there's been a few whipsaws recently. We talked about this. The biggest one coming toward the end of that 6% sell-off. A lot of back and forth movement, but with that holding, and again, bearish patterns not playing out, momentum has swung back up. So it's going to take maybe a little bit longer, more consistent run to have these stay in bullish mode here, but having more positive bars, so blue and green, than negative, or even some of these neutral readings in amber, obviously gives us indication that the trend is still in favor. Now, from a weekly perspective, this is much more important because we now had 32 straight weeks of being in go mode, right? Ever since it flipped here in May. And so obviously off the lows, but as we were talking about just then, just right as it was happening, is that this takes hold when momentum really shifts, and coming after a big downturn like we saw is when the weekly GoNoGo indicator could really give us indication of a much longer uptrend beginning, right? And we saw it before. This is how it happened at the end of 2022. Didn't see it until the beginning stages of 2023, but that lasted all the way, right, through 2024, through the beginning of 2025. So look how long and how much of this rally it captured. Go further back. We won't talk about all of these, but we have in the past. When that first occurred after the COVID lows, right, in the summer of 2020, it stayed with us, right? Nailed this run all the way until the very beginning stages of 2022. So at the very least, if we know that the weekly GoNoGo indicator remains, with a blue or green bar, we're still in the trend. We're still in the trade if we were had to use that to get in for a longer term momentum type strategy. So an important one to keep an eye on. Of course, we talk about it all the time at CappThesis. And now from a very short-term point of view, again, another tool that we use to give us an idea of how the market is reacting. And it's just looking at, on the 2-hour chart, the 14-period RSI, where look how many times, we can go even further back, but we want to give us a very clear view here, that we saw this indicator come back down and hit oversold territory. And what happened every single time it did? Rally. Now, sometimes it didn't automatically get back to new highs, but it kept this bid in play to the point where just touching this line, this 30 line, led to strong multi-week rallies, and most of them made new highs. So what we're looking for now, again, we just made a new marginal high today, is to see this indicator once more hit overbought territory. And at that point, guess what? Probably time for a pullback. Again, that's won't be a concern. The concern is if we fail to see this indicator back get above overbought territory. Now, for a time, it did not hit overbought territory, going from, again, late October all the way until late December. Now, it didn't mean that the market was falling apart, but this was not what you would call an environment conducive to buying breakouts because it didn't work. When breakouts work, again, we have low to high volatility, but from a very short-term basis, we have buyers come in after weakness, and that buying is strong enough then to push this short-term indicator back to overbought territory. And that's what we have for today. Don't forget to check out these other videos you can access right here.